Commodities are rewriting the playbook. Gold demand is shifting, oil stays as volatile as ever, and macro signals are, well, anything but quiet. Today, we are going to decode the noise with someone who, well, lives and breathes the space. Good day. I'm Franco Duplessis, your market analyst here at ATFX Africa, and welcome to the Market Brief. Today, we are joined by Tammy Da Costa, an independent analyst who, well, specializes in commodities. Our theme for today is navigating commodities in a shifting economy. So, we are going to explore gold's renewed allure, the geopolitics, market dynamics, super cycles, portfolio construction, and how to adapt when rate expectations are swinging. Tammy, it is absolutely amazing to have you back on the show. Thank you for joining us. How are you doing today?
Thank you, Francois. Thank you. It's good to be back. I can't complain. I'm very good. And how are you?
I'm doing absolutely fantastic. So, Tammy, I think let's just jump straight into it. Let's get started with our session here today. So, let's kick things off with everyone's favorite shiny metal, gold. So, over the past year, we've seen central banks as active buyers. And how do you interpret this trend? And what might it signal for longer term commodity investors joining us here today?
So today I thought I would also share some stats, and I'm just going to share my screen and then jump to the chart so that we can actually give traders a better perspective and a better understanding of what's been happening. So, Francois, if we
Absolutely
look
fantastic.
specifically at gold, and if we look at what drives demand for gold, we can see that there's there's basically different things that we can look at. So, can you see my screen?
I can. Yes. Thank you so much. Perfect.
Okay, perfect. So what we have here is if we look at supply and demand statistics, for example, we've got, and this was from June 2025, so it has been changing a little bit, but we have all the different categories. So from jewelry fabrication to tech to the central bank holdings. And we can see that the gold price has clearly been on an upward trajectory, but we can see that there have been shifts in, for example, the jewelry fabrication, because now economies are quieting down. So we've got less demand in terms of jewelry fabrication. But what is really, really interesting is if we go and we see some of the other components, such as central banks have definitely been increasing their holdings. And then we can go further into it, and we can also see how different countries have been increasing their holdings. And this comes down to also a concept known as de-dollarization. So I'm just going to jump to the chart while we're actually also talking about it. Okay, so now we're jumping into what's actually been driving this whole rally. And I think what's important to realize is not only are we changing the environment that we're in, but we can see, for example, gold futures, silver has been up. A year to date, copper's also been up. So we've generally got, and we talk about commodity cycles, but a lot of these cycles aren't standard. So let's focus on gold for now. And we can see that gold there's definitely an upward trajectory. I've put the 12-month moving average because that's prices over the past year. And we can see that even though, and we spoke about this the last time, we've got those long wicks at the top that have been a bit of pushback when prices have been really high. It's still supporting the upside narrative. Now, what I thought would be quite interesting is if we look at the Forex heat map. Now, what can we see about the US dollar? The US dollar has taken a beating against majority of currencies, and that's because of the interest rate narrative and so forth. So this has been a clear driver of gold, but not only gold. We see all the other commodities as well. And so I think if we're talking about cycles, there's definitely that de-dollarization trend that's been sparking the rally, and that is also why central banks are now increasing their holdings. And we also see ETFs that have been exponentially increasing. So I think gold is still really exciting. It's still one of my favorite assets at the moment, or commodities rather. But I think we definitely need to monitor that trend, and I don't see it coming down anytime soon.
Absolutely fantastic. And it's very interesting that you say, I'm not seeing it come down anytime soon, because that was actually my follow-up question where I wanted to ask, from your perspective, in your opinion, I mean, even when we were looking at your gold chart now, so right there where you are now, there is quite a big pullback back to that moving average. And is there any potential for any particular risk that you might see on the horizon that traders should also keep in mind, and not just have one directional bias?
So, I mean, this is the monthly chart. So it's obviously taking like a broader perspective. And since 2023, we have seen, and that's also to do with like a weaker dollar. But I think for now, as long as, look, we still do have those pullbacks. And I think that is, especially with the trend being as bullish as it is, we do still have, you've got those, a lot of profit taking at the higher levels. So that's definitely still a risk. But Francois, to be honest, where I'm seeing more of a risk, and I've been studying this quite in depth, is we're seeing now gold give up some gains to Bitcoin, for example. And there's a lot of, is Bitcoin actually a commodity? I think it is. It's still mined. It's limited supply. And those regulatory changes have been bolstering prices for Bitcoin. We've also seen those at record highs. Now, generally, we would see Bitcoin as a riskier asset, but that's not the base case at the moment. And as I said, because now central banks are also increasing holdings of Bitcoin, so now it's giving gold a bit of a run for its money. And then we see AI investments as well. So NASDAQ, the S&P, that's been reaching record highs, and we don't generally see that same trend where we've got gold, we've got Bitcoin, and we've got US indices in the same direction. So at some point, in my opinion, like something's got to break, but there's also a huge concentration risk in assets such as, well, the S&P and NASDAQ, because those magnificent 7 or the top 10 holdings make up a huge, huge portion of those stock indices, whereas gold has been around for millennia. So it has definitely got more of that appeal as a safe haven. To me, what extent it is, yes, it is testing record highs consecutively, but we have also seen that it's been failing to break that 3,300 level for some time. So we've always got risks of a pullback, but the general narrative, in my opinion, is still bullish, because if we look at the economies, we look at current geopolitical risks, they're still there. And gold is still definitely used as a hedge against those risks.
Absolutely perfect.
Super tight spreads. Yeah, tighter than your jeans after Christmas lunch. What if you could get this value today? Turns out you can. Join ATFX now and let's get you started.
So, as a continuation on the gold discussion that we are having at the moment, I mean, geopolitics are still influencing price action across the board. We are seeing Trump getting involved now with meetings with Putin. He just had a meeting with Zelensky. Now he's trying to put Putin and Zelensky in one room. And as a gold trader, how do you separate short-term from sentiment-driven moves? And how do you separate these two from a trend that is genuinely sustainable in commodities, as a question?
So to be honest, I enjoy, while looking at the futures markets, because that is where you see the big investors, or you see those holdings, because for gold futures, for example, they expecting the physical delivery of those commodities. So I look at things like the per-call ratios and things like that, which also give us, and we've got the CFTC reports on Fridays, and that gives us a clear picture of who is holding what and speculative positioning. So I like using that. on a Friday, just looking at it and just to see, okay, how are the alterations in, for example, speculative positionings versus the institutions. But if we also look at just the charts, we can then look at something like a daily chart. I mean, on the 8th of August, futures hit a record high. Why was that? Because that is when they said that gold bars would also be, or there would still be imposition on tariffs on gold bars. And then as soon as Trump then came out and said, no, that's not the case, we did see a retracement, but it still failed to break that 3,300 level. So I still use technical analysis. I still believe that that is still quite a nice guide as to your historical highs, your lows, and just to see, especially on like the daily time frames, you do still see those support and resistance levels. I do use my moving averages, my different momentum indicators. So that's how I gauge the shorter term. And then, as I said, my monthly charts or my weekly are always used to actually see the momentum of the primary trend. And we've seen that momentum, that bullish momentum increasing. And that's why my base case is still bullish.
Absolutely fantastic. Yeah, I know when the news hit that there could be potential tariffs on Swiss gold and gold bars, etc., the market just kind of lost it for a little bit. But speaking about that, we keep hearing gold bugs like having this chatter about a potential commodity supercycle. Do you believe there's any evidence of this, or are current moves more cyclical in nature? What's your opinion on this?
So this is quite a tricky one. And the reason I say that is because cycles or the cyclical nature for commodities, we often see or we hear of Dr. Copper. So copper is generally seen as as basically a barometer of economic health. But now we've also had those tariffs and everything. So we've seen, even though economies aren't necessarily growing so quickly, we see Dr. Copper is still performing well. And that is also, we have to look at other trends such as AI and such as other things that are now using more copper. Silver is an industrial metal, but it's been taking on a role as a certain safe haven as well. So there's a lot of structural components that are now changing. So it's not a usual commodity cycle, in my opinion. We've now got a lot of other factors, political factors, structural changes, and everything that is also influencing prices. Something like oil, we can say, oh, it's a commodity cycle because the economies are now not growing as quickly, but we have to take into account the pace at which OPEC has been increasing production. We have to take into account the fact that those green energy initiatives in the US aren't so prominent now. So that's all been contributing to oil like decline. And then we do see, like I said, gold, copper, silver, which don't necessarily, gold and silver usually they rise in tandem. But something like copper doesn't necessarily have those same components or the characteristics. So I think it is a super cycle, but I think in a different way than we've previously perceived. So I think we need to, especially, I do a lot of regression analysis and econometrics, and I think a lot of those factors now, if you altering them or putting them into your models, we do see that they're definitely contributing. Just the extent of those contributions it's still relatively new. But I do think the base case for commodities as it stands, and especially with tariffs and everything, there's still room to rise.
Zero commission on stocks? Yeah, nothing. What if you could get this value today? Turns out you can. Join ATFX now and let's get you started.
Super interesting, I must say. But you mentioned quite a range of commodities right now. And I know there's quite a few traders probably watching this today who's trying to build a more diversified commodities portfolio. Now, I know most of us trade gold, but I know you really like trading more volatile heavy assets like silver. And I know me and you have had multiple conversations about that. My blood pressure starts rising when you talk about trading silver and I get super anxious. But how do you manage stability within a more diversified portfolio? Is there any guidelines you could provide on, I don't know, position sizing, correlation management, or anything in that regard that you find most effective?
Definitely. I think, and all those factors that you mentioned, like position sizing, correlations, those are key. Those are critical. And as you said, for example, silver, we might see, okay, so gold futures are up 1.3% on the month, whereas silver, we've been seeing a lot of big changes. I mean, it's not uncommon now to see silver up over 2% or down 2% on the day. So position sizes is a big one. I've got my position management and risk management on more volatile commodities like silver is a lot more stringent. So I will look at then shorter time frames like the hourly chart to just see those more narrow ranges. And then it's okay. If I've got a short, if my stop gets hit, then so be it. We're not always going to get the timing on the markets right, 100%, but we need to realize that correlations are important. So if you're trading gold and silver and just commodities that are moving in the same direction, what is your hedge? Is it the US dollar? Because that's what I also use, because most commodities trade against the dollar. But I think definitely with position sizes, and to be honest, Francois, like I trade a lot of commodities because I've been in that industry for a long time. But my advice to new traders is don't just jump in and get excited and want to trade everything. Get to know a product, study it, and even with gold, if you're trading it on a daily basis or looking at the factors that are driving it, you can still make a decent return and you can study it and then you can branch out. So from gold, you might go to silver and even lithium, copper, you can branch out and there's so much potential for a commodity portfolio.
Well, hopefully one day I'll get there too. But you also mentioned the dollar just now. And I mean, there's been so much speculation now about a September rate cut. And I mean, it also, the percentages or the odds of this is fluctuating quite a lot at the moment. And I mean, we are seeing these rapid expectation swings where, I mean, literally a couple of weeks ago, it was like 75% chance of a rate cut. Then it went all the way to like 96%. Today, we're down to about 85% again. So in your view, how should traders adapt or position themselves when they are trading something like gold or silver that is very much affected by interest rate decisions so that they can adapt or react efficiently with these various swings that we could particularly have? Is there something in particular that you have in your playbook that assists you with these fast-moving macro events?
So that's why I do believe that the economic calendar is definitely important. The economic calendar, I mean, it's available on most platforms, and just look at high risk events. So you don't have to look at everything. And for example, when you've got the non-farm payrolls that comes out, you can see all inflation data. That has definitely been increasing volatility, and you see huge fluctuations. So for a beginner trader as well, maybe you want to stay clear of those kind of events, because we often then see markets go wild. It's the repricing of expectations, and it's not the same narrative as before. So now, once again, it's not just inflation and interest rates at play. It's political pressure for the Fed to cut rates, changes in the board. So all of those contribute. And as I said, it's a lot less predictable now in terms of how we've seen those market movements than before. So to me, I've even been staying clear of trading like on inflation data and so forth, because the markets have been going wild. And even I'm having difficulties sometimes actually seeing those reactions and justifying them. So if you do want to, my advice, as I said, I would say look at where there's high importance, high impact news events, and maybe, if you really want to protect your portfolio and you're scared of volatility, rather wait half an hour before, half an hour afterwards, because that's where you see that volatility kick in. And then you can always look at how the expectations have changed, and then you can always go to your positions and change your strategy as you feel fit.
Tammy, this has been super insightful as always. And thank you so much for sharing your perspective on all these various different commodities with our viewers. To our viewers, if you found this useful, please drop your questions for Tammy in the comment section. And while you are doing that, tell us, what do you want us to unpack next? So during our next discussion, what would you like us to have a bit of a discussion about? And then that wraps up your daily market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Simply head over to ATFX Africa by clicking in the link in the description and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.